Welcome to Polaris Live. This is Sarwar Kashmeri welcoming our viewers from around the world to the series of programs on the United States and China in the world. This program is the second of a special series in which Polaris Live invited 7 experts from the U.S., China, and the Middle East to offer their perspectives on the recently concluded 20th Communist Party conference in Beijing. These programs are brought to you live in conjunction with the Foreign Policy Association in New York. My guest today is Mr. Marc Chandler. Mr. Chandler has been covering the global capital markets for more than 30 years, including stints as the global head of currency strategy for both HSBC and Brown Brothers Harriman. Chandler recently joined Bannockburn Global Forex as a managing director and chief market strategist in 2018. A prolific writer and speaker, Chandler appears regularly in the financial media. He's often quoted in the Financial Times, the Wall Street Journal, Barron's, Bloomberg, and the Washington Post, among others. Marc also provides his insights and commentary on the markets on the most widely watched financial news channels, including CNBC, Bloomberg TV, CNN, and Fox Business. Would you please join me in welcoming Mr. Marc Chandler? Good afternoon, Mr. Chandler. I apologize for saying that you've recently joined Bannockburn. You've been there now for almost 3 years, haven't you?
Yes, I suppose recently is all relative, huh? Just a part of a long career.
Well, listen, I see you sitting there on Wall Street at the top of the world, so what can I say? We are lucky to have you. Thanks for taking the time.
Thank you. I enjoyed listening to your podcast, and I look forward to participating in the discussion.
So, Marc, let me ask you this 20th anniversary Chinese Communist Party conference ended last weekend, right? And it was smoothly run. And if one was to listen to it, everything is hunky-dory. Everything is running on time. The COVID-19 has perturbed but not overly disturbed. Can you just tell us, looking at it from your perspective as a currency foreign exchange expert, where China is on the trajectory of ever-climbing economy?
Ever-climbing economy. Well, China is running into some troubles, and I think that broadly speaking, the problem is a couple of years in the making, at least, and it's not clear that coming out of the 20th Party Congress that the major thrust of economic policy and COVID policy are going to change very much. And what that means, I think, is that the key sector, part of the, but how are people? What's the engine of the economy? And in many respects, the engine of the Chinese economy for the last several years has been the same thing that was in the U.S. Earlier, 20 years ago, in Europe as well, and that's the property market. That's a place where people put savings. So it was not just the stock market, but in buying real estate, buying houses, sometimes before they're even constructed. And this property market has a combination of factors have led its demise. And it's like Humpty Dumpty falling off the wall. There's a lot of pieces out there, and it was a real source of demand. Think about construction, a source of demand for all those materials. And so as the property engine of the economy has sort of driven to excess, and now has more than sputtered, but has really stalled out, it's got these ripple effects throughout the economy. And that comes on top of the other challenges it may have. And what this has meant really is that in the beginning of this year, China, to borrow 10 years, China offered 125 basis points more than the U.S. did. And now it's at a discount of about 150 basis points. What this means is that as the U.S. has been raising interest rates and Europe's been raising interest rates and Australia and Canada, the UK, that China, like Japan, has had the ease policy. And this has had implications for foreign investment going into China.
Well, that's very interesting because the property market drives so much, but in China, the property market is this complex mixture of state banks and local banks and farmers banks, as well as the Chinese central banking system. Can you put that in some context for us?
Yeah, I don't have the numbers at the top of my head, but I would think of it something like this, that it's true that, we think about how big the state sector is in China, and you're right, it has dominated the property market through different mechanisms. And the issue is, what is the central government's sort of backing of those local bonds?
Right.
And it's not clear that China is going to, that the federal government is going to stand by it. That is going to, it didn't have a guarantee of them. There's not an insurance. There's been no explicit promise. And, we sometimes in the U.S. have faced the same type of challenge in some ways, thinking about the relationship between the agencies like Fannie Mae and Freddie Mac and the U.S. Treasury bond. They trade at a differential. And partly it's a liquidity differential, but partly in the past, it had been a question of will the government stand by Fannie Mae and Freddie Mac? What kind of guarantee is that? And that's been resolved, I think, in the U.S. And I think that people accept those Fannie Mae, Freddie Mac bonds as good as U.S. Treasuries. So they're held by central banks as reserves.
Right.
China's case, this is posing a challenge for what we'd call a high yield bond market, a junk bond market, below investment grade. And I think people are concerned the ripple effects of this throughout the Chinese economy. So leaving aside the politics and the Communist Party Congress itself, just on economic grounds, I think many foreign investors have become more skeptical about China's outlook, weakening economy, lower interest rates, and a stock market that has really underperformed as well. The CSI 300, the largest 300 companies that are listed in China, it's down about 25% this year.
Wow. Well, let me ask you a related topic. The zero COVID policy in China, right? I mean, it's the opinion of Western experts that this is causing serious damage to China, locking down cities for long periods of time, especially the high-powered cities that drive the Chinese economy, like Shanghai and so on. Do you have any thoughts on that? Do you think that that what China is doing, which is basically saying, okay, we'll balance the slow growth with very low COVID, and we'll take that hit. Do you think this is sustainable? They can continue doing this?
Well, I do think they're going to continue doing this. I mean, what strikes me, and as much as I can follow what's happened in China, the people who made those decisions, the man who made the decisions about locking down Shanghai and who oversaw that, was just promoted deeper into the central government and the Politburo. So I do think China is going to stick with this zero COVID policy. I do think it's disruptive to China, but I want to say partly from an investor perspective, it has also been disruptive to some trade issues, especially when certain supports or important places we have, for example, more recently, areas that had a lot of warehouses and held inventory before they went to the ships was locked down. And so this, of course, is a challenge to the world economy as it also tries to reopen post-COVID. And so this is part of the supply shocks. But I do think that if we try to think about what will be the case rather than what we wish to be the case, I think that China sticks with the zero tolerance for COVID. Because remember, the vaccine, as far as I've seen, understood to be the case that China's homegrown vaccine was weaker, not less efficient than, say, the mRNA vaccines that many of us in the West had. And so you've got a smaller part of the population covered with a weaker vaccine. And of course, I mean, with 1.2, 1.3 billion people, the kind of strategy China has is not going to be necessarily fitting for other countries with different population sizes, different types of concerns, different types of vaccines.
That's so. I think that's so pertinent. Yeah, I was thinking of the UK in the last few weeks, right? The prime minister who, after I guess some weeks, had to leave because the markets did not accept the financial picture that she was painting. This could never happen in China, right? And is that, you think, a weakness that no matter what the markets do, the leadership is now set for 5 years? Do you read it that
You
way?
raise a good question, I think, because I would interpret what happened in the UK along very similar lines. That here was the Johnson government had collapsed, a Truss campaigned on a fiscal stimulus, tax cuts, spending increases,
Right.
and she won the rank and file vote on that. And as the markets tried to digest, that is to say, they were shocked that a politician in the UK was going to carry through with what it committed to in this promise in the campaign. And so the market sold off. That is to say, the bond market yields jumped. Sterling crashed to levels we've never seen before, 103.50.
Right.
I mean, so that gave the wherewithal, I think, to the Tory MPs who, in the leadership contest, they did not vote for Truss. That is to say, Truss didn't have a majority of them. Sunak rather had the majority, and so the bottom line here is that as soon as the MPs could, they tossed her out, and so to me that's an example of a capital strike. Same thing we've seen happen when leftists, like in Colombia, try to change policy in a way that's anti-investors. Capital strikes, and I think you raise an important question: can capital strike China?
Yes.
And I think we began seeing that, and I think that we saw that after the Congress ended. I've read several newswire reports quoting people talking about how China is uninvestable. And I think it was a gross exaggeration. I think it maybe was Lenin who talked about that capitalists would sell, that the capitalists would basically create their own ropes to hang themselves. But I think that this is a question of the integration of China in the global capital markets. But I do think that it's important integration. I think that in some ways that's really what's happened over the last 10, 15 years. We talk about China being integrated in the World Trade Organization, but it's also capital markets were integrated so that if you have a pension fund or a 401k and you have international exposure, you probably have some Chinese stocks,
right?
Whether directly from the mainland or from the ones that are listed in Hong Kong or the ones that are listed in the U.S. China's integration of the capital markets can go into reverse. Whether or not it does is a different story, but I think that it can, and I just don't know. My sense would be something like this, that in the U.S., we saw in the U.K., it's very salient about the investor's power. I'm not so sure that the Chinese officials would bow to international capital pressure. Speculative pressure. Sometimes investors, we think of our people who are investing in our 401ks as not speculators because they're trying to manage the risk somehow. But at the end of the day, from a foreign point of view, whether it is a large mutual fund manager or a rich person or a family office, I'm not sure it makes that much of a difference.
Clarify one thing for our viewers, Mark. In 30 years, China has gone from a almost developing country economy to approaching middle class. Not quite there, but what does this mean as far as their currency is concerned? Has the currency, as a percentage, the world power of that currency in 30 years, has it dramatically changed against the dollar and the euro, the yen? Is it? 900 million people have been brought out of poverty, are the statistics, right? Has the renminbi also become as strong percentage-wise?
Well, there's different ways to measure it, and I think China has come a very long distance in the last 20 or 30 years. I think about a couple of the highlights to me would be inclusion in the SDR, the special drawing right at the IMF. China has a weighting, and most recently that weighting was revised a little bit higher. So as an important international currency,
Right.
leaving aside political, the political dialogue around it, China is an important currency. It's included in the special drawing rights at the IMF, which is international money. During the financial crisis, and again during COVID, there was a new SDR allotment. So countries that were credited with SDRs, in effect, also have Chinese renminbi. And second thing I'd say is that in terms of the international payment system, it's really a messaging system, but it's used for payments called SWIFT. The RMB share of like transactions is in, say, the mid to high 2% area. It really hasn't changed significantly for several years. This partly reflects that the renminbi is not convertible. We think about like the dollar, or you think about like Mexico, Canada. You go to the airport and you want the local currency, you can get it there, but you can't do China. China's currency you can only get onshore in China, and so the lack of convertibility on the current account basis may also prevent its usefulness on a SWIFT system. On the other hand, as another reserve currency, it has increased its share, but I'd say a chunk of it, maybe as much as half of it, maybe that might be a little bit of an exaggeration, comes from Russia when Russia decided to move away. Well, depending on how you look at it, being kicked off or being voluntarily leaving the dollar system, and they sold their dollar reserves, and it looks like they bought a lot of China instead. And as China and Russia trade increases, it's not surprising that Russia, or maybe even some other relatively small countries, pick up some more RMB for their reserve purposes.
Well, along the same lines, you brought up Russia. So there was quite a bit of news that Russia and China have started trading in rubles and the RMB. That this was portrayed as, part of what China is doing to reduce dependency on the dollar. So what I want to ask you is that, Russia has an economy, if I remember correctly, the size of Spain, maybe a little more. Do you think it's even possible anymore, given the dollar's huge weight in the world, for a country to eliminate dependence in the dollar? I mean, do you think that China will ever come close to that?
I don't know. I mean, it's the dollar's role, even if China wanted to get away from it. And, there's a lot of ways that other countries are helping it. For example, talk of the Saudis maybe denominating oil in RMB for the Chinese. This really I want to say this doesn't really take seriously what's really happened in the last 40 or 50 years, and that is the capital markets have grown so much that they really dominate. That to really understand the dollar's role in the world economy, I don't think trade is really that significant of a part. Here's how I think about it: the foreign exchange market, which I really like as you introduced me. I've spent my career. I've always been fascinated by it. The latest estimates suggest that the average daily turnover, is something on the magnitude of, say, $6.5 trillion a day. $6.5 trillion a day, average daily turnover. What is global trade? Maybe 30 trillion a year. That means in 1 week, the foreign exchange turnover is enough to cover world trade for a year. And maybe that's not even a big enough example of how big the capital markets are, and the currency markets in particular. The world GDP, everything, all the value, the dollar value of all the goods and services the world economy is going to produce is about $90 trillion. Wow. We do that in less than 3 weeks in the foreign exchange market.
Wow. It's almost...
and to me, yeah, I'm sorry.
No, please go ahead.
So to me, when I try to think about what's going to influence the value of the dollar, what's going to influence the value of the RMB, and this past week there was talk that if the U.S. Congress passes this bill that would allow lawsuits brought against OPEC as a cartel, that they might sell their treasuries. They have about $120 billion or so of treasuries, according to the U.S. Treasury Department. That might understate it a bit, but so what? They sell it. What happens? I'd say that they themselves are cutting the nose to spite the face.
Right.
They lose interest because wherever almost any country that is the same investment grade as the U.S. is going to have a lower interest rate right now.
Right.
Secondly, the U.S. market is so big that the liquidity is there to be able to be maybe one of the few bond markets that could absorb $100 billion worth of sales by the Saudis, and not really, it won't even be the big highlight of the day. And so I think the same thing is in China's case, is that what really is going to influence the RMB is not going to be so much trade, and they do have a very large trade surplus. But there's other countries.
China does.
China has a large trade surplus. About half of it comes from the United States.
Right.
And so, so down the road, of course, it doesn't make sense that the U.S. is reliant on China for, say, medicine, pharmaceuticals. At the same time, it doesn't make sense that China can rely on the U.S. or any of its allies for certain types of semiconductor goods. So I think that there already is some kind of decoupling taking place, but that ultimately it's going to be about this capital market integration. And we've seen some sort of shots across the bow of either China divesting from the U.S. or U.S. not delisting Chinese companies. Right. And so, for me, yes, there's, the talk about tariffs and this kind of thing, but the non-tariff barriers to trade and the non-tariff sanctions are so much more powerful than the tariffs. The latest actions by the Biden administration on semiconductor chips and on employees working for Chinese companies or U.S. companies servicing Chinese companies. Now, this is a big non-tariff major blow, and I think that this is just the heightened tensions that we're going to have to deal with, even post the 20th Party of Congress.
It's. I was going to tell you that I followed this 20th conference as much as anybody can outside China, and I've wondered. We could not have a week-long conference that sets American strategy for the next 5 years without spending at least a whole day talking about currencies and capital markets and all of these things, the dollar and interest rates. And there was very little that came out of this week-long conference on the renminbi, right? And I'm wondering now, based on everything you said, is that because really, besides the dollar, there isn't anything that approaches it in the market, in the world? So there isn't that much to talk about.
Yeah, not much to talk about with the RMB. Yeah, I think that, they didn't talk about the stock market. They didn't talk really about the capital markets, but the people, it seems, who have been are on the rise within the Politburo, the Standing Committee, are not necessarily who one would think about as being economic reformers. It's still possible that the situation with the property market, with other economic difficulties, that the non-reformers are forced just out of pragmatism to come up with other ways, and some market reforms might end up to be helpful. I wonder too, what we saw happen right after the Congress, before the Congress, I should say, that the PBOC was keeping the exchange rate fairly stable, below 7.25. That is for the dollar level, 7.25 RMB. And as soon as the Congress ended, the dollar jumped up, and that's why, as we record here today on the 26th, that the interesting thing that happened was that after making new highs, the dollar reversed against the Chinese currency, and amid talk of state-owned banks, but then most of those large banks in China state-owned, and perhaps even the PBOC, the central bank itself, might have taken action in the foreign exchange market, both in the mainland and in Hong Kong, where the offshore yuan trades. And this has caused a big reversal. And it's interesting because it's taking place at the same time that the dollar has broadly was turning down against, including the Japanese yen, who had intervened directly in the foreign exchange market previously. So it's a very interesting development with the RMB. I think that what the Chinese are trying to avoid is this downward spiral, this vicious cycle where the RMB falls. So people say, well, I don't want to hold Chinese bonds anymore or Chinese stocks. And they sell the Chinese stocks and bonds, and it leads to more currency depreciation. And so this vicious cycle. And I think they want to break that cycle. And I don't think they want to have speculators benefit from depreciation of the RMB.
Mark, sitting on Wall Street and dealing in foreign currency exchanges and everything else that you've seen on Wall Street, do you think, I mean, Wall Street works on information, right? I mean, that's one of the prime ingredients of the work that drives the work you do. Do you think that from the Chinese system, is it open enough that you get enough information in time? It used to be a completely opaque, closed system, but then they started obviously to open up. Where are we now? If you compare Wall Street, Frankfurt, London as the 100% bar, where would you say, this might be a difficult question to answer, but I need to get some sense for it. Where do you think the Chinese currency is compared to those as far as openness and transmitting information that could be used on the major exchanges like America's?
Yeah, no, it's a good question because there still is a high degree of opaqueness, which I think China purposely has. It's not accidental. And I think that there's relationships between the government, the PBOC, the state-owned banks. And so it's not always clear whether they're ordered to do something. I'll give you an example. Back last September, the Federal Reserve hinted that they were going to change policy, that they were going to begin moving away from COVID, the emergency measures. Right. Between then, September of last year, through before March, when they finally raised interest rates, our 2-year note yield rose by about 120 basis points. It was a sharp move as the markets began anticipating what officials were going to do because the officials told them what they wanted to do.
Right.
I think the same thing works in China, whether, of course, the MBAs and the Wall Street types, of course, we'll talk about things as forward guidance. But what it really is open mouth policy, where officials tell us what they want and we sometimes deliver it. Not always, but sometimes we deliver it. And Chinese government, the PBOC says, listen, the RMB is weakening too quickly. And so we hear state-owned banks buy some. Whether they were told to buy some, what the government's liability is for that, how much they stand behind it, a possible loss, it's all like unclear. But in other ways, China has taken some steps in what we'd want to say called the right direction. For example, up until a few years ago, China didn't release the composition of its reserves to the IMF.
Composition meaning how much of the major currencies it holds?
Exactly. How many dollars, euros, yen, Australian dollars, Canadian dollars. And so China kept those. So when the IMF reports those reserves, there's a category called allocated reserves, unallocated reserves. China had been in the unallocated reserves until a few years ago. They moved into the allocated part. And so I think that there's a lot of misconceptions because China is so opaque. I think there's a lot of misconceptions. So, for example, most recently, despite the fact that a weaker currency could ostensibly help boost exports, China's been trying to stop its currency from weakening. It's not looking for that kind of help for its exports right now. It might have in the past, it might in the future, but right now it's trying to stop the RMB from weakening much more. And I think that with the help of the dollar turning, it might get some success, even though they are easing interest rates while the Federal Reserve is raising interest rates.
Wow. We are running into a time issue here, but we still have a few minutes. And I wanted to switch the focus to the poor consumer as we talk about disengaging with China, as we talk about cutting the supply lines, putting more pressure on them. Do you really think it's good for the American consumer to disconnect even consumer items being made in China? I mean, already, the price of food has doubled, the price of clothing has increased, and so on. Can we really disengage? The world has come so far, we've gotten so wealthy in many ways. Can we really disengage to the extent everybody wants to from China?
Yeah, that's a good question. I'm not sure the extent that we'll be able to, but I think that part of it is that in the U.S., the elites, businesses, politicians, often who represent them, sold American families, sold us on the idea of globalization. And we found out on this side of it that it might be good for us as consumers to buy cheap things, but it hasn't been good for us as workers, as employees, especially at relatively, say, respected or higher paid jobs like in manufacturing. And so I think what's going to happen is that manufacturing output is going to come back to the U.S. You see this already in the new U.S., Mexico, Canada free trade agreement about the importance of the domestic content. You see this with this new push towards reshoring or nearshoring. And I think that this all points in the same direction, I think, of trying to decouple places and bring back production. The problem is that to make it competitive, so that to make the goods still price competitively, it's going to probably mean that less workers are actually employed and more machines are. And so I worry about that. I worry about this a hope that we get these industrial production back here, but that becomes decoupled from the employment that we typically are going to associate with that.
Well, we have run out of time, but I have a final question for you. If you got a few minutes with President Xi Jinping, relations between China and America, what might be one thing you would advise him to do?
Yeah, what a good question. If we had this, like, if I had that luxury of like having just like that elevator pitch to Xi.
Yes.
It's like in some ways I feel like where to begin. But in other ways, I wonder if part of it is the of course, as an American, as someone who thinks that the Enlightenment, the separation of the church and state, is one of the greatest things that we as human beings have developed. And I think China didn't really accept the Enlightenment in the sense that so we in the West have experienced the separation of the church and the state. And this created some space for civil society. And I think that in effect, what Xi has done is not just that the Communist Party has taken over. Please, the Communist Party took over in 1949. What's taken over now is a certain wing of that Communist Party, so the Xi's wing, and it has done away with any kind of potential source of criticism or other ideas. And so that's what I would do. Is I would just, I guess what occurs to me is like I would try to make a pitch for the Enlightenment, for the separation of the church and the state. And of course, in China, they've replaced the church with Xi's faction of the Communist Party.
Wow. What a way to end this program, with a talk of enlightenment in the globe. And so, listen, I'm afraid that's all the time we have, Marc, and I really want to thank you for appearing again for this conversation. I think it's shed a whole other dimension of light on this conversation about China and the U.S.
Thank you.
And I want to thank our viewers from around the world. Please join us again for the next episode in this special series of programs in which American, Chinese, and Middle Eastern experts talk about the recently concluded 20th Chinese Communist Party conference and about U.S.-China relations in the world. Until I see you again, this is Sarwar Kashmiri. Goodbye.